How's it going, everybody? And welcome back to the Real FI Podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it going today, James?
It's going well, Patrick. Thank you for that introduction. I'm super excited about today's guest because we are going to be nerding out about real estate, taxes, saving money, and of course, deferring all the money that you owe to Uncle Sam. Nobody wants to pay that, and they want to pay as little as possible all the time. So we've got our guest today, Yonah Weiss. Yonah is an expert in cost segregation, real estate investing, and a lot of other things, which we're going to get into. So without further ado, Yonah, how's it going, my friend? How are you doing today?
Doing pretty well. Thank God. Things are good. Great to be on the show.
Yeah, perfect. So why don't you give our listeners a little bit of background about what you do, kind of what your businesses are, and what you've got your hands in?
Well, I am known throughout the real estate world as the Cost Seg King. That means cost segregation is my area of expertise. I've been involved in the space for about 5-6 years now. And our company, Madison SPECS, is the largest national cost segregation company. But before that, I was involved in real estate in various different ways. Actually, my background was in teaching. So I was a teacher for about 15 years. And then I found real estate and really tried to learn everything I could. Really, that teaching kind of just bug that's in me that I always want to just learn as much as I can so that I can teach it to others. And that's really what it was with real estate as well. So I kept figuring out different things and then found ways to help other people through that. And then cost segregation came across my plate, this company actually that I work for. And it was really a great match. They were looking for someone to help with the business development. I was looking for a new opportunity at that time, and it just seemed like a great fit, great company. And that's really, I mean, the long short of it. But yeah, definitely happy to break down all the other things that I'm involved with, real estate investing, passively, actively, and all that kind of stuff.
Yeah, no. For everyone out there, before we even go into that background, just do a quick overview of what we're even talking about when we say cost segregation.
It's a weird name for a great tax benefit. Essentially, anytime you own a piece of real estate, besides for your primary residence, you are allowed to take a deduction on your taxes called depreciation. Okay. And that, people think about that and like, oh yeah, depreciation, I know it, but they don't really look too deeply into it. And depreciation isn't what it sounds like. It doesn't mean that your property is going down in value. It just means the IRS gives you a tax deduction as if it were going down in value. And based on that principle, you're literally able to take a tax write-off of the entire value of your property over a 27 and a half or 39-year period, depending if it's commercial or residential. Now, cost segregation is just an advanced form of that depreciation. It allows you to segregate the cost, meaning break down the property into different components, into different categories that allow you to take some of those depreciation deductions at a faster rate. So essentially, in the first year or the first few years of ownership, you can literally take sometimes 20 or 30% of that pool of potential deductions and just take, instead of taking just a tiny bit each year, you can pull forward from that the pool of potential deductions and take a big chunk up front.
So you mentioned 20 to 30%. Is that of the purchase price or of the value of the property or the land? Like, what are you envisioning the 20 to 30% being, just so people can kind of conceptualize like what amount that might come out to?
Absolutely. So it's an average. So there's going to be different things, but it is based solely on the purchase price. And so when you buy a property, let's say you buy a property for $1 million, you always have to subtract a certain amount for land, which does not depreciate. Okay. And so that can, depending on where the location of the property is, the type of property, that can be somewhere between, on average, about 10 to 30%. And so let's just say 20% average. You're taking off $200,000 from that $1 million property. The remaining $800,000 you can now depreciate, meaning you can now take that as a tax write-off. So you can't depreciate land, but it's going to be solely based on the purchase price, not on the actual value. So if you buy something extremely undervalued, which is very common, unfortunately, you cannot depreciate the after repair value or the potential appraised value.
Very true. Very true. I for one have used the cost segregation on 2 separate properties so far, and will be doing it again for my 2022 taxes. We we were able to pay zero taxes for 2021 and get almost 25 grand back, all because of the cost segregation study. So it's fan freaking tastic. And I'm really looking forward to diving into this because there's people out there that are listening to this that are still able to go back, a couple years back and still take advantage of this if they haven't, which I can't wait to get into a little bit more. But before we do that, let's go back in time a little bit and just rewind the clock and discuss kind of what got you into real estate, what your portfolio looks like, and then we'll really dive into the meat and potatoes of the cost seg and how it can benefit everyone.
Sure. So as I mentioned, I was a teacher for many years, and at a certain point, I had actually some things happen in my life, maybe call it a midlife crisis, but it was more that a health crisis in my family really just changed my my mindset and realized I needed to be doing something else to provide for my family and just kind of grow wealth. I was not given any real financial education, nor was I really interested growing up. I grew up in a kind of middle class family, didn't really have a lot, had to get a job, at 14 years old, the first, part-time job just to pay for whatever I want to do. So I didn't have that. I had a good work ethic, but I never had any real aspirations for, for money. I was never chasing that. My passion was, like I said, in teaching and helping people. I started a nonprofit. But at a certain point, your finances catch up to you and you really have to be proactive or else, student debt and all that other kind of stuff just stays there almost forever. And I knew I had to make some changes, and so I reached out to some friends of mine just looking for opportunities, and real estate was a common theme that came up among some of my friends and acquaintances that had been successful in various aspects of real estate, and that just got the wheels turning. I'd never looked into it really, I'd never explored it, but the more and more I learned about it, the more I realized there was no ceiling, meaning this was something you could do, and if done right, you could, make a tremendous amount of money and wealth through that. And, as history has shown, millionaires are made from real estate, or millionaires invest in real estate. And that's just simple math to me. It's logic. If people do this, it's not so hard to do, meaning it may be difficult, but it's something that anyone can do. And that got me started. Did some commercial mortgages for a little while, just learning the ropes about commercial real estate, did some residential brokerage, did some hard money lending, did a few fix and flips with a friend, and then realized that was not for me at all. And then this cost seg thing came around. And through that, I've been able to just network in an incredible amount of way. Just because we're the biggest national company, I deal with hundreds of thousands literally of investors across the country in all asset classes. And so I've been able to network with and meet and rub shoulders with some of the most successful people out there, and learned a tremendous amount through that being a guest on podcasts like this, meeting guys like you, and hosting my own podcast as well. And so that has led me to invest passively in a lot of deals, and has led me to really kind of transition. What's happening right now is becoming more of an active investor as well. So my portfolio currently, I don't have any assets that I own on my own at all. So I'm not an operator. That's never been really my path. However, investing in passive real estate, I'm invested as a limited partner in mobile home parks, in RV parks, multifamily, self-storage, and a couple other businesses as well. So there's definitely a lot that's been learned, and I just love the opportunity.
So I'm curious to know what really drawed you into the cost seg business, because, when everyone looks at real estate, they get into it for pretty much the same reason. They want to maybe find some financial independence. They want to build a business. And a lot of times people just default to the single family home and buy a rental, scale up. Maybe I'll get some multifamily at some point.
Mm-hmm.
But, it seems like you went through this process of, going through some other opportunities, but you landed in the cost segregation business. Did you have some sort of financial background, or what really made you land in this kind of business to really grow your real estate roots?
I have no idea. That's the honest answer. There was no real logic into it whatsoever. It was literally an opportunity. I had done a few other things before that. I realized I didn't want to really be an active investor. I didn't enjoy the fix and flips that we did. And so I was not really a buy and hold type person that I wanted to manage my own properties. And I saw actually my parents at that point, already after I had moved out and had, my own family, they invested in a few single family properties out of state. And just discussing with them what that was like, I also realized that really wasn't something that I was interested in either. There wasn't great cash flow, almost none. And there was appreciation, but I kind of had to find the right place, the right market, et cetera. So I just really was open to this opportunity. And I didn't have any financial background in terms of, accounting background, no engineering background. The company I work for, they are the experts. So they have a whole team of CPAs, whole team of engineers. I was coming in more as, like I said, a business development. And so my background in teaching really gave me that upper edge to be able to just teach this content. And the surprising thing to me at that time, and now it's no longer surprising, was that almost nobody knew what this thing called cost segregation is. I mean, it's just, I talked to every single person that I knew when I first started in this business, and there were essentially two answers, okay, with opposite ends of the spectrum, and almost nothing in the middle. One answer was, yeah, I know what cost segregation is. It's great. I use it, right? It's like, this is the best thing since sliced bread, like Patrick said, right? You pay no taxes. I mean, how better can this be? And so that was one group of people that I spoke to. And the other group of people, which was the vast majority, literally like over 80% of the people I knew who were in the real estate business, said, I've never heard of this. Never heard of it. Not, oh yeah, it's great. I don't think about it too much, or I never, used it, but it's a good strategy, whatever. No, never heard of it. And so as I started exploring this and just kind of teaching it, using social media and using forums like that, Bigger Pockets, to just answer questions about this, I realized how much of a gap there was in the real estate investing space and their knowledge of this subject. So I literally just went all in teaching this and just, spreading the knowledge about this so that it can be more commonplace in the real estate world.
Yeah. I mean, do you think that part of the reason that is because the 20% were larger when I say larger, I mean buying properties that are in, that 10, 20 plus unit range, over kind of $1 million, and that other 80% might have been mom and pop newer investors that are playing in that, single family to under 10 unit market?
You'd be surprised. And in fact, the answer to the first part of the question, yes. Those who didn't know about it were people that had much larger portfolios, who had been in real estate for a long time. One person in particular, who was one of my mentors, was a guy who I asked about this company, before joining it. And this guy's been in real estate for 30, 35 years, real estate developer, owns, hundreds of millions in industrial properties. And he was like, oh yeah, I use Madison SPECS for all my cost seg. They're great. Right. And so for me, that was like, okay, this guy knows about it. He thinks they're great people. It was a good sign for me to join the company. But the other 80% were people who were, brokers, mortgage brokers, people who were, yes, like you said, single families, but others who were active investors who have been, doing this for, maybe 3-5 years and just never knew about it. So it wasn't something that literally came with like the investment, packet of, how do I get started in real estate? It wasn't on the top 10 list of things you need to know about.
Gotcha. Now, before we continue to go down this lane, being an LP, a limited partner in some of these different passive investments, are you still able to have the benefit of the cost segregation, and kind of enlighten everybody a little bit on what being a LP or limited partner means inside of some of these investments?
So a limited partner is a partnership in typically a syndication. So you'll have a model where a group of people come together to buy a property. Okay, some people actively manage it. Those are called GPs or general partners. And then you'll have people that their only involvement is writing a check, and they're called a limited partner, an LP, and they'll be getting a return on their investment based on whatever the terms of that agreement was. So as a limited partner, an LP, you own a portion of that real estate. Okay, if it's set up that way, and the majority of partnerships are set up that way, which means that not only will you receive a percentage or portion of the returns of the property, you also get the depreciation according to your percentage of ownership. So if you have a 10% stake in an investment property as a limited partner, you don't have any involvement in the management of it, but you will still get 10% of the depreciation that gets allocated from that property. So it is still a great investment, strategy if you are looking for those taxes. However, the tax deductions, however, it is limited, and this is a really important point, unless you are a real estate professional full-time, those deductions are going to be limited just to offset your rental or your passive income.
So with your work in the cost seg field, you come across a lot of sponsors and operators who are doing great, maybe subpar, maybe less than great work. So you really get to see the operations from the inside. And I know that you've got some really good insight into this. How do you pick a really fantastic LP deal or sponsor? And along those lines, what's more important to you? Are you looking at the deal when you're making these investments, or are you more so putting your eggs into the basket of the sponsor and whoever's the operator is?
Excellent question. It's, for me personally, just to use this cliche, you bet on the jockey, not on the horse, right? Meaning there are plenty of deals that could be great on paper, but if the sponsors or the people running that are not experienced or are not, in my eyes, the most trustworthy, then I would stay far away from that. So to answer your question, for me personally, I look more at the sponsors. I try to develop relationships with them over a period of months or years before putting any money with them, and just kind of watching their track record and learning more about them, and just getting more comfortable with them. And I think it's a really important thing to do, because unfortunately, like you said, there are subpar people out there. I mean, there are hundreds of these syndicators, and many of them relatively new to the space. And so the past 5 years have been great for the real estate space, especially commercial real estate, multifamily. It's been a great run. And so you really didn't have to do anything to make money, except, not like shoot yourself in the foot. Unfortunately, nowadays, the past year or so, especially with rates going up as they have, mortgage interest rates, it's now going to be more telling who is a great operator and who's going to be, making money and continuing to drive their investments and give returns to their investors. So it's been very difficult right now, I'd say the past 6 months or so, to find a good deal, because the good operators are really sitting on the back, sitting on the sidelines for a little bit and just, waiting for the right deals to pencil out.
That makes a lot of sense. That makes a ton of sense. And I also think for people out there that are maybe looking to not necessarily get into a syndication model, but if you're looking to develop a partnership or have limited partners, the cost segregation that we're about to discuss and the benefits of it are another selling point to some of these, high net worth individuals, high income earning individuals that you're going to be going after to invest in you, invest in your business, and invest in your deal. Because like you just explained, as being a part of an owner in this deal, that depreciation, that tax benefit will flow down based on their ownership. And they can also, which I'm sure we'll get into, they can carry that over into years. So it might not benefit them for 2022, 2023, but if they're getting closer to retirement, some of these other things, this kind of lump sum will be there when they need it ultimately. Correct?
That's correct. Yeah, that's a great point. The losses or the deductions, if you can't use them in the current year, do carry forward. You can use them in the next year and future years until either they run out or until the property sells, in which case any of those losses are released and can be used in that year against other passive gains. So it is a great strategy, even if you cannot use it in the current year, it still can be beneficial down the road.
So, Yonah, you had mentioned that you're involved in a plethora of different types of asset classes within real estate. You've got RV, self-storage, multifamily. And all of those, if you can just visualize them in your mind, they're constructed differently. These are different types of buildings, different types of uses. Everything is different about each of these assets, but I'm sure that has some sort of effect on the process of doing a cost segregation and maybe the outcome. So with your experience in these types of assets, which have you found to be the types of assets that you can write off the most with a cost seg analysis, and which ones maybe don't yield the most return on that analysis?
So from a tax perspective and cost segregation, certain components of the property, like we mentioned, are going to be depreciate faster. What's amazing about cost seg is that you have, like we said, land doesn't depreciate. You have the majority is always going to be going to the structure of the type of buildings, but there's something else called land improvements. Okay, land improvements means anything on top of the land, like pavement, concrete, landscaping, fencing, that's outside the property, depreciates on a 15-year schedule. And in a roundabout way, I'm explaining why RV parks and mobile home parks happen to be the best type of investment vehicle for accelerated depreciation for cost segregation. We literally just did a study on a property this week that got a 94% bonus depreciation. What that means is 94% of the basis, meaning after you subtract for land, the amount of the property, it was like a $4.5 million property. We're talking about like close to $4 million was that depreciation deduction that you can accelerate. And with bonus depreciation can take upfront in the first year. Now that's almost unheard of. In fact, it's the first time, the highest one that I've ever seen. But for RV parks and mobile home parks, because you essentially own almost nothing besides the land, which again doesn't depreciate, and the land improvements once on top of the land. If you there, on this property in particular, there was only one structure, which was like a small laundry room that was on the property. Everything else, the people own their own RVs. There are some, hookups to electric and stuff like that, but everything else was just like gravel and pavement and brick pavement and landscaping and fencing and all that good stuff. So it was that by far is off the charts. On a more practical level, because that's not always something, an opportunity that comes your way. Multifamily, self-storage, retail, they'll all come in typically around 20 to 30% of the total value that you can depreciate in the first year, or the faster depreciation schedule. So that's something to kind of take a look at. There are certain cases where it can go up to 35, 40%. Being accelerated depreciation. But again, whenever you're dealing with buildings, the majority of the value is always going to be in the structure, in the structural components, the roof, walls, windows, doors, infrastructure, that kind of stuff.
Yeah. And I think majority of the listeners that we have are going to fit into that kind of multifamily range where we're talking like flooring, cabinetry, vanities, refrigerators, stoves, appliances, right? Like all of that kind of stuff that's in there. And it's just saying, hey, here's the value of that. And we're just going to wipe it all away the first year, that 20 to 30%, like you're saying. Now, what's really nice is if you're a real estate agent or you happen to have, you do real estate, any type of, you become a real estate professional, whether you're a flipper or an agent or someone that is doing 750 hours a year or more and qualifies as a real estate professional. What's really nice is that this income or these deductions can pass through you and go to your spouse to wipe off their income as well. If you're filing together. Which I don't think some people realize. And the cool thing is that if you're building these up right now, you're thinking, hey, this might not benefit me right now. Well, if you're planning in the next year or two to become a real estate professional, you can do them now. Or, you can tell your CPA or your tax person, hey, let's not go heavy on the depreciation right now, because we can do this cost seg in a year or two when I plan on becoming a real estate professional, and start thinking about your taxes long term.
It's so huge. That real estate professional status is beyond almost comprehension. It's like the IRS has given a golden ticket to anyone who chooses the real estate business, because again, you can use those depreciation deductions to offset your active income or your spouse's income, which means you can be a high W-2 earner and your spouse be a real estate professional, or vice versa. And you can literally, if investing in rental properties and getting cost segregations done, you can literally be paying no taxes. And it's just crazy to think about that.
It really is.
So, going off what Patrick was just suggesting there, Patrick was talking about doing a delayed cost seg analysis. And I think that some people, especially myself, when I first learned about it, thought, oh, well, dang, it's too late. I've already bought the property a couple years ago, and I didn't do this analysis, so there's no way I'm going to benefit from this. But, what is your perspective on that as far as the timeline of purchasing and the optionality of doing the cost seg afterwards? Like, does it need to be done right when you purchase, or can it be done at a later date?
So because it is a tax tool or a strategy, it's going to work for different people at different times, right? You may benefit from the cost seg if you have income, let's say in a different year than the first year. It can be done in the first year, and a lot of people like to get it done in the first year of ownership just to set up their taxes properly from the beginning, but it does not need to be. Like Patrick mentioned, you can get it done on a property you've owned for a number of years, and it actually does not require you to amend your previous year's taxes, which I've actually heard some CPAs get wrong. So this is something all you need to do is file what's called a catch-up or a change of accounting method going forward. So you can catch up whatever depreciation you missed that you could have taken previously and take it this year going forward with what's a Form 3115. It's like I said, a change of accounting method form.
Yeah, that's super, super interesting. Now, where what I was going with on this, not only crap, I totally forgot my train of thought there. I was like, wait a minute, James. We mess up sometimes, whatever. During the
you gotta have some time, some bloopers for the blooper reel, right?
We got to
keep them.
But yeah, no, what I was gonna say is the bonus depreciation that we're talking about. This is where I was going. For 2023, we're only allowed to do 80%. Next year, 60-40, right? Is that can you go into that a little bit so people kind of understand what that means, and especially how it's affecting the cost segregation?
Sure. So backtrack a little bit to 2017, there was this tax reform that happened called the Tax Cuts and Jobs Act. One rule that they introduced was this thing called 100% bonus depreciation, which means once you get a cost segregation study done, you were at least able to take 100% of those accelerated deductions in the first year. Okay, so going back to our examples, right, 20-30% on average, like a multifamily property, you can take, instead of spreading that over a 5-year or a 15-year schedule with the different components that depreciate faster, you can now take those upfront in the first year. So that 100% bonus depreciation was a huge boost for, I think, the real estate industry and the economy in general over the past 5 years. However, in that bill that was passed, it was set to phase out by 20% each year starting in 2023. So this year, it's at 80% bonus. So if you buy a property in 2023, you're only able to take 80% of those accelerated deductions in the first year. The remaining 20% can still be spread out over those accelerated rates of 5 or 15 years for those respective components, but it's not going to be all that lump sum in the first year. And like you said, Patrick, it's going to continue to phase out by 20% each year until it's totally gone.
So something that I think, based on this conversation that we should also wrap this into is paying the piper at the end of this life cycle of the real estate purchase, acquisition, and cost seg. So, let's just imagine that someone's purchased $1 million multifamily. They've done the cost seg. They're writing off, $250,000 over a period of time that they've owned it. But now they're looking to sell. And let's just kind of forget for a moment 1031. What are the consequences of kind of selling a property after you've done the cost seg analysis to reflect that on your taxes?
So anytime you sell a property, you're going to be subject to what's called depreciation recapture tax. So it does not mean that you pay back the depreciation. Let's just get that out in the front. It does not mean you're paying back anything. Okay. What it means is you're going to be subject to a tax on the amount of depreciation taken. So that's considered an unrealized gain. Similar to capital gain tax, if you make a profit on the sale, you're going to be subject to a tax on that profit. So too, with depreciation, since you've benefited from that, you're going to be subject to that tax on the sale. And what I mean by subject to is very different than actually meaning paying it, because they're two completely different things. Okay. Number one, you can defer that if you do a 1031 exchange, like you mentioned. You can defer that recapture tax. The other thing, you can have other losses, like we mentioned earlier. If you have those suspended passive losses, they'll be released on sale, and can help to reduce that recapture tax. There are other strategies as well to help reduce that, or even entirely get rid of that tax. However, what's important to note is that if you are planning on buying properties from year to year, okay, if you're a real estate investor, you can use the depreciation from one property to actually offset that recapture tax on the sale of a different property. And some people like to call this the lazy 1031 exchange, right? Like doing a 1031 exchange will actually allow you to defer that capital gain tax and defer that recapture tax. But if you do a cost seg on a property that you buy in the year that you sell another property without a 1031, you can use those losses from depreciation to offset the gain from the sale of the other property. Now, and again, that's offsetting it, that's reducing it, eliminating it, not deferring it out further. So again, another thing to note on this recapture tax is there are 3 different rates that this recapture tax is based on. And so one rate is on a maxed out at 25%, and that's usually the majority of that recapture tax. And that is probably less than, and again, it's maxed out that, so it's subject to your income tax rate. And so that's less than had you just paid that tax by not taking those deductions earlier on. So in the end of the day, cost segregation is a great time value of money play. And even though you do have to deal with, like you said, pay the piper, if that comes to that, right? Meaning it will happen that you're going to have that tax when you sell, but if planned right and, just having the right strategy and business plan, you can not only, get around that, you can actually, just continue to scale in the interim so that the returns you're getting from using that money to reinvest, far outweigh any tax that you might pay sometime down the road.
Yeah, I think one of the things that you hit on there, and I just want to reemphasize, was if you plan right. That means you need to be having these discussions with your CPA, with your tax strategist, with an expert, and talk about what your plan for your portfolio is. Hey, are we planning on selling a property this year? Are we planning on selling a property next year? What do we have? You know what? You should go out and buy some real estate this year if you want to sell that property next year. You need to be having these discussions so you can talk about how you can maximize all of this depreciation, all of this against your taxes. These are strategies that we're trying to help you provide. And it's not a one size fits all. It's not just, hey, I bought a property, I'm going to depreciate it, we're going to figure it out. Like you said, you can take these over X amount of years, you can build them up to offset some things. Like this is so powerful if you don't just see it at face value and say, oh, I'm going to get to write this off this year. If you actually use it as an investing strategy, like you can exponentially grow your income, you can exponentially limit your taxes and take full advantage of what the government is giving you the ability to do. And I just really want to emphasize that because you said it right there. Like it's a strategy, and you have to be strategic in using this and partner up with the right people to make sure that you're leveraging it to your full advantage.
100%.
And I think something for people to be aware of is, especially on the LP side of things, you're not necessarily going to have all the control over the investment. So, when it comes to the disposition of the property, you might have a difficult time 1031ing it into something new. So you're going to be maybe stuck with that recapture tax as well. So, even those passive investments, you should be talking with your sponsors, talking with the GP, see what their plans are if they haven't already set that forth. So when to expect to make these payments in the future. Of course, hopefully property's selling for a gain and you're going to have some money to, pay that tax with, but
right.
Planning ahead can't be understated.
100%.
Exactly. Now let's get into the cost a little bit. The cost of the cost seg. I mean, I know it's property specific, value, all of that kind of stuff, but let's just say for our average investor that's listening, what would you say the range of something like this would cost for a $500 to $1 million property? If you could kind of give us a ballpark.
Sure. So the first is that it's never going to be based on the value or the purchase price or even the tax deductions whatsoever. So it's not a contingency. You're going to get a $100,000 deduction. We're going to charge you 10% of that. No, it has nothing to do with that. I know there are other types of tax credits and programs out there that do charge on that type of basis. Cost segregation is not like that. So there is going to be a flat fee based on the size or type of property. I can speak currently to what our fees are at this time. 2023, got in trouble a few years ago when I said on a podcast something, and then the prices went up, et cetera. But currently, like for single families, we charge about $3,000, and that's kind of our starting point for a full engineer cost segregation study. It does go up when you get into higher types of bigger types of properties. The more work scope of work that's involved, like a large retail or office building where there's going to be more job, and the engineer can get up to $6,000, $7,000, $8,000 range. Rarely will you find a type of property that's going to be like above $10,000. I mean, we do, and we're the biggest national company that does this. Last year, we did over 7,000 properties. I'd say like probably 2 to 3% of those were over $10,000. And we're talking about very large, skyscrapers and large shopping malls and things like that, where there's just a huge amount of work involved.
I think that's great for everyone listening out there. Cause like just where I can speak of, we were able to write off a little over $180,000 on our taxes from doing one of these, which resulted in us getting money back, that more than like exponentially covered the cost of what one of these was, so when you're thinking, oh man, is the $3,000 worth it? Is the $5,000 worth it? I would say, probably 90% of the time it's going to be more than worth it and cover the cost of itself. Just for everybody out there, kind of thinking about, hey, this is great. What's the cost? I think that's a really, really good one. Now, key piece is, do I have to do the cost segregation in the year of when I'm, filing for those taxes? Like, did I need to do one in 2022 for using it on my 2022 taxes?
Yeah, it can be done as long as it's done before you file your taxes. Then it's good. It doesn't need to be done in the calendar year that the property was bought. So right now we're, at the beginning of 2023, you can still file your 2022 taxes, especially if you're on extension, which, goes out to September, October. You have plenty of time to get that done.
And that's what we'll be doing. We are on an extension until September. So it's like, hey, let's make sure that's happening. So, all right. Now let's get into, your goals a little bit. Like, do you necessarily have a goal for helping a certain amount of people? Is it to getting to a certain passive income number for yourself, for your family? Like, let's get into that a little bit.
For me personally, I mean, I try to live by what's called the HOPE method, which is acronym for help one person every day. And so that's the bare minimum, right? If I've done that, then my day has been a day. It's been an accomplished day. Now, obviously, the more, the merrier, right? The more people you can help, the better the day, the better the life you can be. So there's for me, that's always been my number one thing. The more money you can make, the more people you can help. I mean, that's simply my life kind of strategy. Passive income is awesome. It is great. It means you can do more things with your time. I have 6 kids, so the more time I can spend with them, the better. But there's no real, I don't personally have any specific goals in terms of money, in terms of passive income or anything like that. I do have, thank God, a good amount of passive income coming from investments and, a great amount of active income as well from multiple income streams. So right now, I think in a good space, you absolutely need to, if you're a listener here and thinking about, how can I get involved? There are so many ways that you can, and you just need to invest in whatever way you can in order to start building those income streams. I came, like we said, we were talking about 8 years ago, I was in, $100,000 of student debt and other debt. And it was, eating me away. I was enjoying life. I didn't really think about it too much. But then when push came to shove and I had a medical crisis in my family, my back was against the wall and I had very little choices. But I'm here to tell you that, 8 years may seem like a long time, but it's, my life and my financial journey is literally night and day from what it was. And it really just comes down to networking and education and going out there and just trying to provide value for others.
So let's just dig into that a little bit more because
Yeah.
I think it's very, very notable that you don't have like any specific door count, passive income number. You're focusing on giving back and you're letting the universe bring that back to you in whatever way it comes back, whether it's financially or with relationships, however you're rewarded by the universe after that. So what are you doing to help one person every day? And what are those systems in your life look like? Like, how are you giving back? What are you doing?
The easiest way for me, because of my involvement in social media, is really, and just, I'm like a people connector. I like to connect people, and I see opportunities that come through connecting one person to another. Just because I like to do it. I'm not out there trying to make money from any of those introductions or anything like that. I know people are, but that's not my philosophy. Just, hey, I think this person would be a great guest on your podcast. I think this person, oh, you're looking for, an attorney in North Carolina here, reach out to this person. Oh, here you're looking for, a tax advisor, reach out to him. It's because of my network has become so large and I have such a powerful, network through that. I'm able to make those connections all day long. And to me, that's the easiest way. There are other things that I do. I have several nonprofits that I help in my community, just giving as much as I can possibly to help, just underprivileged families and people that have gone through struggles like, I've been there. You have financial crisis, you have a medical crisis, you have a death in the family. So there are things that are out of our control. And when you have someone that can look out for you or take care of you, I think that, to me, I'm so blessed and privileged to be in that position to help people in those situations.
One of the most unique personality types, I think, are those connectors. It's something that I personally work hard at trying to emulate. It's very hard, because, and I think it's probably hard for everybody to become good at it. But I think that when you look at the people in your life and those people who just give by referral and give by connecting, they always gain a special place, at least personally in my life, because, I always know they're there for me and they literally just have the best interest in mind and they're, just trying to give back. So I think that's awesome.
What would you recommend for someone that just really connected with everything you say, you just said there, on how they could start to possibly, do the same thing?
It really just starts. It starts through education. You hear something like this, you're constantly like, well, how do I do it practically? I mean, there are plenty of books out there. I think a great way to, to kind of get this concept when it comes from a social media standpoint. A lot of people kind of just scroll and people are doing stuff like that and not really involved. There are great communities out there. And so it's really about figuring out where your community is and how to find the right people. Gary Vaynerchuk has a lot of great tips and books on the subject. Jab, 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 right hook is something that, is a great book that talks about just adding value, constantly adding value, adding value, adding value. And then maybe eventually asking if there is anything ever to ask, but focusing on adding value first. I think that's the first place to look for. If you're looking for just to find people to add value to, you just have to look for it, right? If someone's asking for something, you may just pass it by. You're like, hold on one second. Sorry, someone just came into my office. We can cut that out. Someone just like knocked on my door and walked into my office.
Totally fine.
No, you're totally good. This is real life. It's
very
real
well
life.
meaning.
We're trying to give real life advice, during everything. Like this happens. We forget our trains of thoughts. People interrupt. That's how the day goes, but I love your thing, about just trying to help one person every day. And with that, I'd really like to know, what kind of obstacle do you see yourself facing being able to accomplish that every day? Like, do you see any obstacle in being able to do that? Or is it, just that you're setting your mind to this one task and that's the goal of every single day?
There's always obstacles. There are constantly obstacles in everything, in every aspect of life. If you don't have obstacles, you're doing something wrong. But having that framework, whatever your framework is, just reviewing your goals, if you have any, is going to set you in motion to be successful. And so that's why I kind of set the bar so low. Help one person every day. It does not take a lot to help one person every day. And to me, it's almost comical because I say that like the hope, how one percent. I mean, because it's so easy. Anyone and everyone can do this. But when your mindset is focused on, okay, I need to look outside of myself, right? We are constantly bombarded with just thinking about ourselves and being self-centered. And I think that is part of the degradation of our society is people are so self-centered and self-focused, when life is really about what you can do for others, right? We're brought here in this world for a purpose, and part of that is being part of the whole. Is not you're not a microcosm. You're not just here in this world alone. And I think people lose sight of that all the time. And so if it's just changing your paradigm a little to focus on others, then I think your life will be in a much better place.
Man, I totally took that to heart right there, and I think that a lot of our listeners out there, I think are doing that as well. So I'm sure on the day that they're listening to this, you've helped out more than one person, and I think that's a perfect segue into our last segment of the show that James and I like to call the Big Four. James, kick it off, bro.
So, Yonah, tell us something that you do that kind of feels like a financial independence hack or a cheat code, something that just kind of has helped you get into the position where you are today.
The biggest, I think, hack or cheat code is just surrounding yourself with people much more successful than yourself. And it's almost cliche, like they say, you are, what your network is your net worth, or you are a product of the 5 people you surround yourself with. But that's so true. It really is, and I found that to be the case. If you just tap into helping other people or focusing on being around people who are much more successful from you, you'll gain so much because you'll tap into their knowledge and into their network, and that's probably the biggest hack that there can be.
Great answer.
In addition to
Great
tapping
answer.
into that too, I think you can feed on other people's energy as well. Like I've noticed that personally when I am surrounding myself with other people who not only know more than I do and doing more than I do, but the energy when that's off the charts, it really motivates me as well. So I love that.
Couldn't agree more. Couldn't agree more. We call this one resources. So are there any specific books, podcasts, or people that have really shaped not only your financial independence journey, but just your overall life journey to become the person that you are sitting in front of us today?
One of the first, if not maybe the first business book that I ever read, and I don't even know if it's categorized as a business book, whatever, but Stephen Covey's The 7 Habits of Highly Successful People was, just a huge trajectory for me at that pivotal moment in my life. And, I'm a firm believer that, you read certain things at certain times and you come across certain things at certain times when your mind is open to it. And so once you kind of open yourself up and allow yourself to want to change and to want to get better, then God, or whatever you call it, the universe will show you things that you need to see in order to make yourself better and to help you improve. So that one book was something that I needed right at that time, and I still go back to it all the time. I literally just looked at it yesterday, but it's such an incredible, powerful book if you haven't read it.
I think that is a great book as well. And would you recommend anything non-business kind of related? Doesn't have to be self-help or anything like that. Just another book that you think our listeners might benefit someone out there.
On the concept that I just mentioned, just because this popped into my head just this second, it's the only reason why I'm mentioning it. But there's a book called Unlocking Greatness by a guy named Charlie Harary, Harary. And it's just an incredible book that talks about the psychology of something I just mentioned here, where, when you're open to opportunities, your mind, just sees things. So that was a book that really opened my eyes to some things as well.
Awesome. Thank you so much for sharing. I know I'm going to go check those out. James, number 3.
So, Yonah, for this one, I want you to kind of envision yourself 5 years in the future, either business wise or in your personal life. Where are you? Like, describe that picture for us. Like, what's going on in Yonah's life 5 years from now?
Well, I'm, hoping to have, some kids that are already, I have a bunch of, teenagers at this point. So hopefully they'll be well, starting their own lives and starting their own families, hopefully. Encourage that at a relatively younger age. So I could see myself as a grandparent already 5 years from now. My daughter's 18, almost 19, and she's thinking about that, and in the near future, possibly. So I think that's something that really means a lot to me. Family has always been really important to me, and watching my kids grow up and become independent and become their own, individual successful people in their own rights is something that's really awesome to me.
Love it.
Fantastic. Freaking tastic. Family is always first. So I love it, Yonah. So for all of our listeners out there that have been educated, motivated, and inspired by our conversation today, where's the best place for them to reach out to you, whether it's just to say thanks or to find out more about cost segregation?
So you can find me on all the social channels. I'm most active on LinkedIn, or Twitter at this point, on Instagram, all the places. But yeah, definitely shoot me a message. Let me know you heard me on this podcast. Definitely happy to connect with anyone and everyone.
Awesome. All right, guys. You guys know the drill. This podcast is free, but it's not free, the information that we're giving you. So all we ask is that you guys do something. And by doing something, that means comment on one of our posts. Go and subscribe to our newsletter. Subscribe to our YouTube channel. Give back to us like we're giving back to you. So with that being said, we'll catch you next time. Thanks a lot.
See you guys.